the UK government is facing a sobering reality. Borrowing money is becoming increasingly expensive, and this trend shows no signs of slowing down. This trend, reflected in rising borrowing costs, has sparked concern among economists and investors alike, who are closely monitoring the situation. It signals a potential strain on the public purse and raises questions about the long-term sustainability of the UK's fiscal approach and economic health. The situation is a complex interplay of global economic forces and domestic policy decisions, making it even more challenging to address. Understanding this intricate web is crucial to navigating the challenges ahead and ensuring economic stability. The UK, like many other nations, relies on borrowing to fund government spending and public projects. When costs rise, servicing this debt becomes more expensive, putting additional pressure on the budget. This can limit the government's ability to invest in essential services and infrastructure, which are crucial for public welfare. The current upward pressure on borrowing costs underscores the need for a careful examination of the factors at play and strategic planning for the future. At the heart of this issue lie gilt yields. These yields represent the interest rates the UK government pays on its debt, specifically on UK government bonds, known as gilts. Gilt yields serve as a key indicator of investor confidence in the UK economy. When yields rise, it suggests investors are demanding a higher return for lending money to the government. This increased demand for higher returns reflects a perception of greater risk associated with UK government debt. Several factors can contribute to this perception, including inflation, economic uncertainty, and concerns about government policies. Monitoring gilt yields is therefore essential for gauging market sentiment and assessing the UK's borrowing costs. The recent rise in UK borrowing costs has drawn comparisons to the tumultuous period following the 2022 mini-budget. However, important distinctions set the current situation apart. The mini-budget, with its unfunded tax cuts, triggered a sharp loss of confidence in the UK government's fiscal prudence. This led to a dramatic spike in gilt yields, pushing up borrowing costs significantly. The current situation, while concerning, does not exhibit the same level of market panic. The risk premium, a measure of investor perception of risk, remains relatively stable compared to the surge witnessed in 2022. This suggests that while investors are demanding higher returns, they are not yet in a full-blown crisis of confidence. The UK's borrowing cost challenges are not solely a domestic issue, but are influenced by external factors. Global economic forces, particularly those emanating from the United States, play a significant role in shaping these challenges. The US, under the second Trump administration, has implemented policies that have fueled inflation expectations worldwide. This has led to a rise in US bond yields, which has a ripple effect on global interest rates, including those in the UK. These US-driven trends transmit to the UK through what is known as a contagion effect, impacting various sectors. As US bond yields rise, investors often seek higher returns elsewhere, including in UK gilts, affecting the local market. This interconnectedness of global financial markets means that the UK cannot entirely insulate itself from the impact of US policy decisions, particularly those with significant implications for inflation and interest rates. However, global factors alone cannot explain the price movements in UK bonds, because other comparable markets, such as Germany, have not experienced the same magnitude of change. This indicates that there are unique elements at play within the UK market that are driving these fluctuations. It is important to note that comparing the current situation with the 2022 mini-budget is misplaced, since that episode triggered turmoil with large unfunded tax cuts and raised fears about rising public debt and credibility. The current fiscal environment, while challenging, does not mirror the same level of immediate crisis. In 2022, the risk premium demanded by investors tripled, while the current risk premium remains close to average, suggesting that financial market participants are less concerned about the UK fiscal situation now. This relative stability in risk premiums indicates a more measured response from investors. Additional UK-specific factors have also contributed to rising borrowing costs. These factors are multifaceted and include both economic and political dimensions. The October 2024 budget played a role by introducing extra spending with a potentially inflationary impact, which may cause the Bank of England to lower interest rates at a slower pace. This cautious approach by the Bank of England reflects concerns about maintaining economic stability. This sensitivity in the gilt market makes it more vulnerable to news and adverse shocks and raises concerns about the sustainability of public debt. The gilt market's reaction to economic news can significantly impact borrowing costs. The role of quantitative easing also plays an important part in this discussion. It has been a critical tool for the Bank of England in managing economic stability. Between 2009 and 2021, the Bank of England purchased a substantial amount of gilts as part of its quantitative easing program to boost the economy, and that totaled £875 billion. This massive intervention had significant implications for the bond market. Since March 2022, the bank has reversed some of these purchases through quantitative tightening, which now results in losses when selling or redeeming gilts in a higher interest rate environment. This shift from easing to tightening marks a significant change in monetary policy. These losses are indemnified by the Treasury and may result in the debt to GDP ratio being around 4 percentage points higher than it would have been otherwise. This indemnification process adds another layer of complexity to the fiscal landscape. The sustainability of United Kingdom public finances faces challenges such as low economic growth and productivity, an aging population, high government debt, and rising borrowing costs. These factors collectively strain the fiscal framework. With real interest rates exceeding real GDP growth, it will be difficult to reduce the debt to GDP ratio without making tough decisions about taxes and public spending, decisions that have been widely avoided. Political will to implement these changes remains uncertain. Furthermore, the October 2024 budget did not significantly raise overall investment or revise GDP estimates sufficiently, while growth and productivity forecasts from the Office for Budget Responsibility appear overly optimistic. This optimism may not align with the economic realities. If sufficient economic growth is not achieved, the United Kingdom finances may remain vulnerable. The path to fiscal stability is heavily dependent on achieving robust economic growth. Looking at potential solutions, the current political environment makes it challenging to cut spending or raise taxes, given the historically high tax burden and the commitment to increased public spending. These constraints limit the government's options. At a recent National Institute of Economic and Social Research webinar, experts urged the government to clarify its mandate and focus on strategies to raise growth rather than on what measures they will not take. Clear and decisive action is needed to foster economic growth. Should tax rises become necessary, experts advocate for taxes that are less detrimental to growth, such as land taxes, value-added taxes, or taxes on the use of non-renewable energy rather than on labor or capital. These tax strategies could support economic growth while addressing fiscal needs. Some economists suggest abandoning current fiscal rules to allow more flexibility in government spending, though such changes could trigger negative market reactions given the recent revamp of fiscal policy. Balancing flexibility with market confidence is crucial. In conclusion, the rising borrowing costs reflect a complex mix of global trends and UK-specific factors that are challenging public finances. Understanding these dynamics is essential for crafting effective policy responses. The Chancellor now faces the task of outlining a coherent and credible path towards budget sustainability through measures that increase productivity, improve spending efficiency, and address the mounting debt challenges. This will require a balanced approach and strategic planning. Thank you for watching this detailed analysis on United Kingdom government borrowing costs. We hope this has provided valuable insights into the complexities of the current fiscal situation. Stay tuned for more insights on economic policy and fiscal developments. We will continue to bring you the latest updates and expert analyses.